For years, I watched the stock market, and something felt off. Companies would announce layoffs, their profits would drop, but somehow their stock prices kept climbing. CEOs got richer, while workers got pink slips. The numbers didn't make sense. Until I discovered what's really happening behind the scenes. In 2024 alone, American companies spent nearly $1 trillion on something that isn't innovation, isn't hiring, isn't paying workers more. It's a financial trick that's been quietly reshaping Wall Street for over 40 years. And once you see it, you can't unsee it. This is the story of stock buybacks. And by the end of this video, you'll understand why the market feels rigged. Let me paint you a picture. It's 2024. Apple just announced it's spending $110 billion not on making better iPhones, not on new factories, but buying its own stock back. Meta, $40 billion. Microsoft, $60 billion authorized. These aren't investments in growth, they're companies purchasing their own shares from the market. And here's what's wild. In 2024, S&P 500 companies set an all-time record, spending $942.5 billion on buybacks. Analysts predict 2025 will hit $1.2 trillion. To put that in perspective, that's more than the entire GDP of most countries. While you're clipping coupons and watching inflation eat your paycheck, corporations are spending trillions buying their own stock. And when I dug into why this happens, I found something that changed how I see the entire stock market. But first, let me take you back to 1982, because what happens next explains everything. Here's something most people don't know. For most of the 20th century, stock buybacks were essentially illegal. That's right, illegal. Under the Securities Exchange Act of 1934, large-scale stock buybacks were considered market manipulation. Think about it. A company buying its own stock to artificially inflate the price. That's manipulation, plain and simple. But then came 1982. The Reagan administration's SEC, under Chairman John Shad, a former Wall Street executive, passed Rule 10b-18. This created a safe harbor that protected companies from market manipulation charges when they bought back their own shares as long as they followed certain guidelines. The result? Buyback volume tripled in the first year. What was once considered market manipulation became Wall Street's favorite financial engineering tool. And here's the kicker. This one rule change set off a chain reaction that would reshape American capitalism. Because when you make it legal and profitable to manipulate your own stock price, guess what happens? Everyone does it. So how does this scheme actually work? It's brilliantly simple. When a company buys back its shares, those shares disappear from the market. Fewer shares available, same profits being divided up, so earnings per share go up even if the company didn't actually earn more money. Here's a real example. Let's say a company has 100 million shares and earns $100 million in profit. That's $1 per share in earnings. Now they buy back 20 million shares. Same $100 million profit, but now divided among only 80 million shares. Boom! Earnings per share just jumped to $1.25. The stock price rises. Headlines say, "Company crushes earnings expectations," but nothing actually changed except the math. And here's where it gets even more twisted. Remember how CEO compensation works in America? Stock options, stock awards, their pay is tied directly to the stock price. In 2024, median CEO compensation jumped nearly 10% to $17.1 million, with the bulk of that coming from stock awards. The median stock award rose 15%, while base salaries only increased 4%. When you can artificially boost your stock price through buybacks, you're essentially writing yourself a bonus check. In between 1980 and 2024, CEO compensation rose over 1,000%, while typical worker pay increased just 24%. This isn't a coincidence. It's a direct result of tying CEO pay to stock prices and then giving them the legal power to manipulate those prices. Now, here's what really bothers me. In 2024, S&P 500 companies returned $1.6 trillion to shareholders, 60% through buybacks, 40% through dividends. That's triple the income of the poorest 27 million households. Think about that. Companies are funneling more money into stock buybacks than the bottom 27 American families earn in a year combined. And who owns the stock? The top 10% of Americans own 93% of all stock wealth. The bottom 50% of Americans own just 1% of the stock market. So when companies spend $1 trillion on buybacks, it's a direct wealth transfer to the people who already have the most, and it comes at a cost. That money could have gone to worker wages and bonuses, research and development, building new factories, investing in innovation, actually growing the business. Instead, it's being used to artificially pump stock prices. And the people who benefit most? The executives, whose compensation depends on those stock prices. Here's a stat that blew my mind. Over the past 5 years, the 5 largest U.S. companies spent more than $1 trillion on stock buybacks and dividends, more than 5 times what they paid in federal taxes over the same period. So back to where we started. Why does the stock market feel rigged? Because fundamentally, it is. Not in a conspiracy theory way, in a structural, legal, systemic way. The game is set up so that companies can legally manipulate their stock prices. CEO compensation is tied to those prices. The wealthiest Americans own almost all the stock. The tax code favors capital gains over wages, and buybacks concentrate wealth instead of distributing it. In 2024, while you were dealing with inflation, job insecurity, and stagnant wages, corporate executives were getting record compensation packages funded by buyback-inflated stock prices. The stock market broke records not because companies were doing better business, but because they were spending historic amounts buying their own shares. They're playing with house money, and the house always wins. When companies announce massive buybacks, Wall Street cheers. Stock prices spike, executives cash in their options, shareholders celebrate, and the workers who actually create the value, they get told there's no budget for raises. This is why the market feels rigged, because at a fundamental level, the rules were changed in 1982 to allow exactly what used to be illegal: companies manipulating their own stock prices for the benefit of executives and wealthy shareholders. I'm not saying buybacks should be banned. That's a whole other debate. I'm saying we need to understand what's actually happening, because when you know the game being played, at least you can make informed decisions. The stock market isn't rising because the economy is booming or companies are innovating faster. It's rising because corporations are spending record amounts buying their own shares. That's not capitalism. That's financial engineering. And now you know the secret. This is why the market feels rigged. Because it literally is, legally, systematically, by design. So here's the deal. If this video finally made everything click, if you've been feeling like something was off and now you finally understand why, I need you to do 3 things. 1, hit that subscribe button because you don't want to miss what's coming next. 2, drop a comment and tell me, did this change how you see the stock market? I read every single comment, and your insights help shape what I cover next. 3, send this to someone, your friend who's always complaining about the stock market, your family member who thinks the system is broken, that coworker who's trying to learn about investing. Just copy the link and send it. It takes 5 seconds. Because here's the thing, the system stays rigged when people don't understand how it works. But when enough people wake up to the game, that's when things start to change. This is Coco Finance Files, and I'll see you in the next one.